first of all, thank you for your time coming to this lecture, to this seminar. And today our speaker is Professor Luintel, who is actually with Cardiff Business School for a very long time. And also before that, I think Professor Luintel was in different places, such as Cardiff, Swansea, and also Brunel University, and internally.
Glasgow.
Okay, so yeah. And internally, I think Professor Luintel has been a very important player to Cardiff Business School. So he served at least 2 terms of head of department of the economic department. And also he's serving as a board member for Cardiff Management Board. So which you can see, a lot of admin along the way. And externally, I can see Professor Luintel has been visiting or associated with different places overseas, including University of Munich, Universitat Catholic de Leuven, which is a Belgian university, very good one, University of Malaga, and Japanese Research Institute, etc., but quite a lot. And more importantly, I think Professor Luintel has been very active in research in the areas that are related to financial economics, international finance, development economics, and a lot of subtopics, as you can see from our introduction. And you can go to the Google Scholar and to look at the publications. You will find that Professor Luintel has published widely in different journals, and they are good journals, such as the Economic Journal, the Review of Economics and Statistics, Journal of Money, Credit and Banking, Research Policy, and also Journal of Development Economics, etc., etc. They are all good. I actually read all of them. So it's it's our great pleasure to have you, Professor Luintel, and particularly we'll appreciate your time, giving you a very busy timetable. And today's topic is very important, I think, is securitization and also banking regulation. So I understand that this is the issue that we have been debating a lot since the 2007 and 8 global financial crisis, where we saw the subprime mortgage was related to the securitization problem, and that created a lot of risks. And then when something went wrong along the chain, then we saw the collapse of the system. So I think today we are talking about the same securitization problem. It is very, very important given the current situation. For example, the regulation things, and especially I heard a lot that people are saying non-bank sector has been growing so quickly, and maybe they are going to be a very important player than the conventional banking sector. But the regulations were designed, set up for those conventional banking sector. But what about those non-banking financial sector? The regulation, I think securitization, which links the conventional banking and the new the shadow banking system, let's say, is very important. So I'm very interested in the topic, and I'm curious to see how you develop this paper, and particularly the modeling of the differences between two basically they are holding two books. So I will give the floor to you, Professor Luintel. And as I said, that we see how everything's going. If we have questions in between, we normally allow people to interact. And I think we just make it more informal
engaging
and interactive. So, and that's good for everybody. So, Professor Luintel, welcome. The floor is yours.
Okay, thank you, Professor Hongbo. First of all, I'm very grateful for your very nice and very elaborated introduction of me. Probably very few people have done this way, and I'm not sure whether I deserve all the accommodation, etc. you have referred to me. First of all, I would like to thank Mengji and yourself for inviting to this seminar. It's a pleasure to be connected with lots of people across the globe, not only within the UK, and talk about my research. And I'm also very grateful that you very nicely summarized the problem we are trying to analyze in this paper. And I believe this will not be the only paper we'll be writing in this area. We are further working on this, and I'll discuss all those things. First of all, let me start, because first, one thing I would like to say is this. These slides are built using LaTeX, and this morning my laptop went a little bit mad, so I have to at times use the draft version of the paper. So even the title here, Securitization, Banks and Macroeconomy, is slightly different. So let me start with this, and then I'll revert back to this one, right? Okay. Can everybody see the paper? So the title of the paper is By the way, before I start, I'm more than happy to interact in between, to be interrupted in between my talks, right? And I want to wind up the talk within 1 hour, 30 minutes, if possible, but let us see what happens. So the title of this paper is Securitization, Bank Regulation, and the Macroeconomy. Now, as Hongbo was summarizing, we had big financial crisis, 2007 and 8. Everybody knows what was the reason behind this. Big shadow banking sector, lot of securitization, banks not maintaining, banks and financial institutions, not only by banks. Normally, we academics tend to understand, unless somebody is well versed in financial economics, we tend to understand high street bank, but big thing goes on behind the desks of investment banks. These banks, both, when I say banks, both high street commercial banks as well as investment, I mean. So these banks maintain very low level of capital base, what we call capital adequacy ratio, and that led also to the problem, and we had a big financial crisis. This story has been narrated widely in press, financial press, in media, everywhere, and a lot of papers have also been written. So I don't want to go into that detail, but I want to tell you what is the motivation. We are economists, and I work in the fringe of finance, macrofinance, macroeconomics. That sort of thing I do. So when we looked at the sort of literature, there has been a lot of papers written addressing one aspect or another aspect of financial crisis, what were the reasons and how it impacted the overall macroeconomy, but not necessarily directly modeling securitization and shadow banking. Therefore, this is what we have tried to do in this paper. So as abstract tells, we develop a general equilibrium framework in which commercial banker, constrained by capital adequacy requirements, creates a special purpose vehicle to hold securitized assets off its balance sheet. That was the core problem which led to financial crisis and gradual depletion of capital base of these banking institutions, which I'm going to show you some data. And this bank, operates this SPV as an independent entity. Thereby, it circumvents regulation, creating a gap between de jure, that means actual, and de facto, that means which is required by law, statutory capital adequacy ratio. We quantify this gap. So until the financial crisis hit, the required capital adequacy ratio was 8% when banks were engaging themselves in these off-balance sheet activities, these loans disappeared from their balance sheet. What capital adequacy required is to maintain a proportion of capital base vis-a-vis the on-balance sheet loans. So if you put together off-balance sheet and on-balance sheet, actually in reality, what percentage of capital these banks were maintaining? We quantify this through simulation, counterfactual analysis from model. So our model also integrates a loan-to-value ratio, collateral constraints which borrowers face, particularly entrepreneurs, together with credit default risk, to examine the dynamic interaction between real and financial sector, both with and without securitization over the business cycle. So I will summarize at the end of the presentation also what main findings are. But what we find, let me briefly say that securitization is mildly expansionary, promotes regulatory arbitrage. That means evade the regulation, increases off-balance sheet lending under tighter regimes, amplifies credit risk, but it does enhance a little bit welfare. Securitization becomes an important tool in bypassing restrictions, stricter regulations such as capital requirement or title loan to value ratio. So the results and our findings suggest that we need a robust oversight of securitization to preserve the integrity of capital regulation. And we also do, if securitization is not properly bought within the regulatory framework, what will happen to the Basel III proposals, which suggest 10 to 15% of risk-weighted capital, equivalent to risk-weighted capital assets, capital adequacy should be 10 to 15%. These are the things we are going to do. So this is paper titled Securitization, Bank Regulation, and the Macroeconomy. Now I'm going to revert to my slides, right? So this is a co-authored paper with my colleague and friend, Jose Torres, who is a professor of economics in Malaga University. So, as Hong summarized, we now widely recognize that shadow banking expanded sharply over the past several decades, particularly since 1990. And it played a central role in triggering the global financial crisis of 2007 and 8. Why? I will show you the data. Commercial banks as well as investment banks were deeply involved in shadow banking activities, which is widely known as securitization, and that gives them opportunity to increase their off-balance sheet activity and compromise the capital adequacy ratio. When initially securitization was invented, probably all of us remember the sudden death of Enron because of these securitization SPVs. But when Enron and the companies like that invented initially in the early 80s, it was regarded as a positive, innovative financial engineering, financial innovation, which would increase liquidity, increase credit supply, diversify risk, and mitigate risk and transfer risk. So that is what. But following the fall of Enron, people have started doubting about the role of securitization, which has helped evade bank regulation, particular capital adequacy ratio, weaken banks' capital reserve base, increase credit risk, increase the systemic risk of the financial system. So there is a very nice thick book by Abmati and Helwig, published in 2013, which provides a very good reading of what goes on and what went on leading up to the financial crisis, and then what we should be doing for reducing the systemic risk of the financial system in coming years.
Yeah. So Professor Luintel, can I ask you? So our audience probably does not know the process yet. So, for example, what is special purpose vehicles?
Okay.
How the securitization process.
Next slide.
Sorry. Yeah.
Next slide. Okay. So, as an economist, we are interested because securitization through financial system affects real sector macroeconomy, hence this model. Okay. Now, Yeah, this is it. Securitization is achieved through special purpose vehicles. What is special purpose vehicle? There are two things. One, think of a big banking institution. Now it has got, let us say, 1 billion worth of loan portfolio, right? So what this bank wants to do is that it wants to lay off, let us say, 20% of that 1 billion loan portfolio. It wants to sell to the wider market, right? Wider market. So loan portfolio is illiquid, but if it can sell that out of 1 billion, let us say 200 million or whatever, 20% to the wider investors in the capital and money markets, all other investors, then it will have access to the liquidity. One. Two, so it's on balance, assuming this 1 billion, I'm giving example following your question. I would have otherwise taken as if everybody knows this. So given this 1 billion loan of this institution, if this institution can sell to the outside market 200 million, that is 20%, then that will be off balance sheet. It will sell that loan to other investors. In the balance sheet of that bank, that would be 800 million rather than 1,000 million, which is 1 billion. So this is what is called, so how it does, it creates an entity called, not generally in the literature known as special purpose vehicle. Why special purpose name? Depends upon which particular type of loan this particular institution bank is trying to sell. For example, these special purpose vehicles may deal with, look at the second red here, typical SPVs are asset-backed securities, collateralized debt obligation, loan obligation, real estate investment trust, venture capitals, infrastructure SPV, lease SPV, insurance-linked securities. So it is not only commercial or investment bank. Any corporation can form these sort of entities to sell, either in the case of bank, their loan, in the case of other corporations, their debentures or whatever, in a particular sort of, and these entities can be open in all sorts of tax havens and other things. So I write here, the sponsoring institution. That means the institution who is trying to establish this special purpose vehicle and raise fund, either by selling, in the case of bank, their existing loan, or selling some other financial instruments in the case of other corporate bodies. These are called sponsoring institutions. Establish these SPVs as a separate legal entities. These entities can take the form of corporation, trust, limited liability company, or any form required by the jurisdiction where the SPVs are being formed. Okay, it must obtain required license or permit to operate from that particular sort of place or country, or wherever they are going to establish these things. So, for example, Barclays is one high street bank in UK. But if Barclays wants to establish a fund, special purpose vehicle called Barclays Investment Fund, it doesn't have to be in UK. It can be in Cayman Islands or wherever it likes. So it has to follow the rules and regulations there. And by definition, Barclays and that special purpose vehicle legally are independent institutions, entities. But now that has subsequently changed following financial crisis. We'll discuss that later when time comes. Okay, this is what SPVs are, and SPVs deal all sorts of assets here. And what these SPVs do, first, they get these assets from the bank, they buy from the bank, sponsoring agencies, and they develop, they sort of organize in different branches depending on the risk profile of these loans. For example, mortgage loan, subprime loan, and other type of loans. And then they sell as A-rated, B-rated, all sorts of with rating. There are rating agencies which hit their quality and rating, and they sell to the outsider investors, particularly big, like pension funds and other investors. They invest, right? And these are investors. These are short-term investments, and that is what was the main reason which triggered financial crisis, which will come subsequently in the next slide. So this is that clear enough, Hong?
Yeah, sorry, cool. Can I call? So we need to understand a little bit of the motivation for commercial banks, normal commercial banks, of setting up these special purpose vehicles. So, for example, why do they do that? Why can they not sell their loans to the normal market? Is there anything to do with the regulation and things like that? So we understand why this is popular, and so that's something. Yeah.
No, because the thing is that there might be regulatory implication as well, which I don't know. But if let us say I borrow X amount of money for mortgage from Barclays Bank, okay, right? So if tomorrow Barclays Bank tries to say that, okay, I want to sell Luintel's mortgage, he's a nice person, so he will keep on paying the mortgage anyway. Why don't you buy this? Nobody will buy. But if you transform this in a sort of, exquisite sort of, attractive investment instrument, then Barclays will be able to sell. So these special purpose vehicles are created first to transform these various type of lendings which these institutions, commercial and investment banks have done to a very attractive investment portfolio for the outside investors, right? That is how it works. Now, so your question that why these commercial banks cannot sell directly, probably they cannot sell. That's why they have established these entities, and there might be other legal implications also, because what they are doing is that they are establishing as an independent, because they're independent entities, these special purpose vehicles who are audited, who has got a board, who has got its one operational sort of rules and regulation. Therefore, commercial banks are selling their lending to these entities. They are converting those lending into different branches of investable sort of instrument, which they sell to the outside investor. So it is not straightforward, just commercial banks who can sell these things. Nobody will be
that risk diversification. But Yana may have something else. Yana knows a lot about banks. Yeah. Yana.
Yeah.
Sorry.
Can I add a couple of things in the securitization and loan sales? In the I think is the structure of the loan sales and securitization is based on the cost, and then it's important is commercial banks or other type of financial institution can able to sell individual loans in the market. There is no restriction on that, but the procedures and cost will be the same as the putting together all the, as you mentioned, it is about the mortgage, that Cool's mortgage and Yener's mortgage and Hong's mortgage. Millions of the individual loans put together, and sort of offload to market. These are the
absolutely. So, whatever your name is, yes, it makes sense, because there are cost implications. There are
regulatory implication as well. It's especially is the pre-crisis when they put to all those loans on the sell it in the market via securitization, is the sort of you are creating first you create a liquidity, second you improve your Basel ratio. So we can continue now.
Yeah. Okay. Right. Okay. Now.
Thank you.
Now let me give you a little bit of insight how this securitization was going on, leading up to how it evolved over the time since 1990. Although the data was long historical, but I just chose 1990. So total outstanding credit in the United States. By the way, this securitization, you might recall that all this subprime bubble started in USA. The extent of securitization is much lower in Europe compared to United States of America. Okay. So total outstanding credit in USA comprising of 1 to 4 family and multi-family residential mortgages, commercial and farm mortgages, commercial and industrial loans, and consumer credit stood 5.2 trillion in 1990 quarter four, of which 1 trillion, which is 19.2%, was securitized in 1990. Come 2007 quarter four, which is close to the financial crisis, total credit had grown from 5.2 trillion to 19 trillion, a compound annual growth rate of 7.6% over those 17.75 years. During the same period, securitized loan volume increased from 1 trillion to 8.4 trillion, average annual growth rate of 12.7% for the 17-18 years. And this increased the securitization ratio of 19.2% in 1990 quarter four to 44.2% in 2007 quarter four. And this is the 2007 quarter four. I say here refers to the period leading up to the global financial crisis, blah, blah, blah. I have given this. Okay, now this scale of securitization left banks and other financial institutions highly leveraged and heavily reliant on short-term funding, often maturing within months, days, or even overnight. When securitization market collapsed, and that I vaguely remember, and you probably might remember more precisely, I think it is in August 2007 for the first time when BNP Paribas, one of the big, large bank of France, said that, okay, because of the subprime turmoil in the United States, they cannot value any of the securities. And when they said that, immediately the market collapsed. And that triggered the financial crisis. So when the securitization market collapsed, these institutions faced severe funding constraint, not only in retail markets, but also in the interbank market and the broader non-bank wholesale market, which triggered global financial crisis. So now I would like to relate this. What did this securitization and this borrowing did? It compromised the bank's capital adequacy. Let us go back a little bit. How bank capital adequacy or capital used to be historically. Until mid-19th century, we are talking about 1840 to 1860, banks typically held equity as high as 40 to 50% of their total assets, which declined to around 25% by early 20th century. When I say early 20th century, I'm talking about 1920 to 1940. By the early 1990s, that means 90 to 94, equity levels have further dropped to 6 to 8%, with a gradual increment in financial engineering and banks and financial institutions being able to, raise liquidity from the market. This capital adequacy, the capital status of these institutions started declining and fell as low as 2 to 3% for major banks worldwide, leading up to the global financial crisis. This sharp decline in equity, combined with heavy reliance on debt, meant that sudden freeze in credit markets quickly pushed many banks into insolvency. So this will be outside the scope of today's presentation. Nevertheless, we all know that, big banks like Lehman Brothers, B.S. Stern, etc., collapsed overnight. And this high securitization ratio remained elevated throughout global financial crisis, peaking at 45.5% in 2009 quarter four, then dropped sharply in 18.8% in 2010 quarter one. That is mainly because of the collapse of private securitization market and the tightening regulatory framework, notably the Dodd-Frank Act in the United States, and there are several other acts. Now, what is the situation now? As of 2024 quarter one, total outstanding credit in the United States is 29.3 trillion, of which 4.2 trillion, that is 14.2% is securitized. So what we say in our paper is that although the ratio of securitization has reduced significantly compared to the global financial crisis and period before it, which was almost over 40 to 45%, to 14%, nevertheless, $4 trillion is a huge sum of money, and it has got the potential to destabilize and create havoc in the financial system unless it is properly monitored and regulated. That is one of the motivation of this paper. So I have plotted this data here. This is, which I have already explained, there is no use of this. And this is a sudden drop in the securitization ratio in 2010. Sorry, the 9 quarter 4, which I mentioned earlier. This is from, okay, that's fine. So what we want to do is the following in this paper. Now I'm going to go. We would like to first look at how much potentially the securitization activity might have compromised the capital adequacy requirement leading up to the financial crisis. Second, as you probably know, the latest regulation proposals are understood by the name of Basel III Endgame proposals, which proposes several type of supervisory and regulatory provisions, including 10 to 15% of risk-weighted, 10 to 15% of the risk-weighted assets to be set aside as the mandatory capital requirement by financial institutions. Now, and frankly speaking, about this should have been concluded almost 2 years ago and agreed upon, but still they are buying time because these banks, they are pushing this further and further in the future because there is a severe lobbying against Basel III Endgame proposals. And the argument being that, securitization leads to expansionary effect to the aggregate economy. It helps to increase credit, etc., diversify risk, etc. Therefore, these Basel III in-game proposals have to be watered down. This is what. So this is what is going on. This is everywhere in the financial press. If you regularly look at Financial Times and other things, these things are there. So one of the things we do in our model is that if securitization is not brought into the regulatory framework fold, then how Basel III in-game proposal will end up looking like, right? That is what we do. And then what we do is, so I write here that JP Morgan, Citigroup, Bank of America, BNP Paribas, HSBC, Deutsche Bank, these are the big banks, as well as other, what we call in the paper, vested groups are against these Basel III in-game proposal. So we do this counterfactual analysis. And finally, what we also do is that we relate with and without securitization various policy shocks and how do they impede on the real macroeconomy of the economy.
Okay, Professor Luintel, do you mind we now allow Jana to ask a question? Jana?
It's not a question, or maybe more in the comments is there. Securitization is there after the 2010 onwards is being picked up again, especially is for the non-performing loans, especially mainly the European financial institution who has the large non-performing loans portfolio, then the ECB, European Central Bank, allow them to securitize and they then pledge to European Central Bank to get a sort of funding from them. So I think this European Central Banks is basically expand their quantitative easings is the any subsidiary is non-European banks, but operating in the subsidiary condition in Europe. So I am not sure your argument is about when you mentioned about the securitization of Basel III. A little bit, we need to have a little bit clarify on that the terms, because actually it's a very big market. There is a non-performing loans is it's being restructured, securitized, and this the asset is being sold or pledged to the European central banks. So that is my comments on your point on regarding the Basel III.
I'm not sure I understood your comment, by the way, but I because I have not even started the model. I only want to say the following. First, maybe a good idea if you can write that an email to me, I'll much appreciate and I'll be grateful. I couldn't quite understand what you were trying to make. I was simply saying that if you look at the securitization in European Union is much smaller scale than USA, right? But regarding Basel III, there is a general lobbying by big banks and those who are working for these big banks against these Basel III in-game proposals. That's all I'm saying. Whether at the micro level and nitty-gritty, what sort of a security assets by which government or country or region is being securitized, I have no information on that.
Yeah, but let me add one thing, Yana.
Yeah.
If I am a commercial bank, after the financial crisis, Basel III asked me to do two things. One is I need to put aside more cash to be ready to respond to shocks. Secondly, they require me to look after the structure of my assets. So risky assets should be reduced. Do you think those things will lead to a decline of my securitized assets?
Yeah,
so,
of course.
So I see the logic between Basel III and the declining of the securitized assets, at least after the global financial crisis. I think probably I answered your question. And can we allow Professor Luintel to continue, please? Please, yes.
Thank you. Right. Okay. Now I'm skipping the literature. I'll just now start model. We have 7 economic agents: workers, entrepreneurs, firms, commercial banks, special purpose vehicles, central bank, and the government. Central bank and government literally do not play a big role here, which I'm going to explain. Right. So this is a very standard real business cycle DSG model. So here is worker, which is a patient agent with higher discount factor, which the worker do not borrow, they work, they supply their labor, and their utility is based on consumption, saving, which is deposit, and leisure, which is 1 minus L. And this is what describes their utility function. By the way, I'm not going to go in any detail or in any very long time in terms of these models, because these are pretty standard stuff, and there needs to be all these things need to be solved and first order condition derived, etc. That is a technical part, and I'm not going to spend much time on this unless somebody has any questions. So this is the utility function of workers. They have households workers. They have got budget constraint, which is expenditure size is consumption and saving. This tau C is tax and consumption, and this household obtains income from labor income and interest from deposits. All the savings are deposited and lump sum transfer. By the way, government, we assume, runs a balanced budget for this sort of modeling approaches and makes a lump sum transfer to these households and entrepreneurs. Okay, so now this is theta or whatever you call is a shock to the consumption, and these sort of shocks follow, and this is shock to the saving. this type of shock. We are not necessarily going to simulate all these shocks. We only simulate relevant shocks. They all follow first order autoregressive process in this type of model, because they are always specified as first order autoregressive process, because these shocks are by definition stationary. Therefore, they have got short memory, not long memory. So this is Lagrangian. I'm going to skip this algebra for optimization, and then I'm going to take you to entrepreneurs now. Now the second household is entrepreneurs, denoted by J. They have got utility function which depends on consumption and ledger. Now workers household, they do not own capital. They earn, they consume, they save. Their saving takes the forms of deposits. The investment is done by entrepreneurs, which are less patient, having lower discount factor than the worker households. And then they invest, they own physical capital, and they also own banks. Okay, this is their utility function. Therefore, their budget constraint is consumption, expenditure. They have got to pay tax, new investment, and this is gross loan payment. And we also allowed for the probability of loan payment by this phi t. So 1 minus phi t will be the probability of default. And their income is wage income, rent from capital, and new borrowing, lump sum transfer from the government, and net bank profit after it is allocated for the 1 minus phi. Phi represents some sort of bank profit. A portion of bank profit may be channeled towards accumulation of bank capital. Okay, this is entrepreneurs. Now this credit default risk, as I said, this phi t is the probability of loan repayment. 1 minus phi t will be the probability of default, and this probability of loan repayment is a function of TFP and amount of bank loan relative to the steady state loan. So if a bank loan increases, the probability of non-payment increases, probability of loan repayment decreases. Similarly, if TFP is negative shock, loan repayment probability reduces, probability of default increases, and vice versa. And this is the shock, TFP shock, which we are going to analyze. Up until now, there is nothing new. This is a static, classic, typical, simple DSG model framework. When we start introducing bank balance sheet and SPV balance sheet and other constraint, then you will start to see a little bit of difference. So now, when there is a probability of default, there is a loan payment risk, then we have to introduce collateral. So this is the constraint, collateral constraint faced by the entrepreneurs, where XJT is the collateral, this phi is the shock, and 1 plus eta T is the loan. So what we effectively are saying is that there has to be collateral XT, which will affect the investment and capital accumulation of entrepreneurs, and this collateral has to be of value greater than the bank loan. That is what this equation says. In simulation, we put set eta equals 1. So effectively, 50% collateral value can be, loan can be only up to the 50% of collateral sort of idea. So this is it. So now you will see this collateral requirement is built in capital accumulation process. So next period capital depends on the net of depreciation capital this period plus new investment minus this collateral. 1 minus theta is the probability of default. If entrepreneurs defaults, it loses its capital stock. That's the idea. It loses its capital stock. Now, it is not only collateral, we also introduce loan to value ratio. That is what banks impose to borrowers. So this is loan to value ratio. So this borrowing is, the the capital stock. What firms do, entrepreneurs do when they borrow is that they place their capital stock as collateral. Therefore, this loan to value release capital stock and the new borrowing here. Okay. Now, this is again Lagrangian optimization. I'm going to skip that. This is model. And then what I'm going to do is that now we have discussed household workers, household, and entrepreneurs' household. They have got utility factor, they maximize their utility, and then they have got their expenditure and income stream. And particularly entrepreneurs face two types of constraint. One is collateral constraint, and another is loan-to-value constraint from banks. Now, the production is done by firms following the standard Abductus production function, where Y is output, A is total factor productivity, capital stock, and labor. This is a constant returns to scale. So this is TFP, which follows autoregressive, cost autoregressive process. And this is the TFP shock. This is very typical in terms of business cycle models to simulate the TFP shock. Now, this is again simple, maximizing firm maximize profit, and which from first order condition we get this sort of wage rate and rental rate of capital, which will be equal to the marginal product of labor and marginal product of capital. That is pretty standard. Now here it is, commercial banks. Now we segregate between unbalanced and off-balance. This is loans to the entrepreneurs, because when the entrepreneurs borrow, this is the asset side. HB is the unbalanced loan. Unbalanced loan is backed by deposits and equity. Off-balanced loan, which is HS, total loan in the financial system is HT, which consists of unbalanced loan and off-balanced loan. By definition, off-balanced loan does not appear in the balance sheet of the commercial banks, therefore it is not valid. So the idea is that what is the motivation, as Hongbo was trying to explain earlier, not trying to, she did explain very neatly in the sense that although in the economy, this is the total HT, is the total amount of loan, banks effectively maintain capital stock B vis-a-vis HB unbalanced loan only. Therefore, 8% of HB unbalanced is not going to be 8% of H, because H, the total loan is bigger than unbalanced loan. Therefore, 8% or 10%, whatever the legal requirement of capital adequacy is, if there is off-balanced activity, securitization, then we call de jure, de facto or real effective capital adequacy ratio is going to be lower than the de jure required and dictated by the law. That is what it is. Okay. So when I explain this also. So I'm saying that, unbalanced loan is backed by deposits and bank capital. And now for the banks, we introduce this regulatory constant capital adequacy ratio constant, which we name as BIS. So there is a continuous time credit constant to commercial banks, which is they have to continuously maintain the capital adequacy ratio, which is determined by the regulatory authority. Okay, they cannot the capital adequacy, the capital stock cannot be less than what is stated to be by law. Now, this is the securitization ratio, HS by Hayes, and then I have already explained that this, this effective capital adequacy ratio is going to be lower than the legal capital adequacy ratio required by banks to maintain because of the existence of HS, or balanced loan. Okay, and now given this constant and this balanced constant and this BIS constant, this is the profit function for the bank. This is probability of repayment. This is the gross loan revenue. And this is what bank sells to special purpose vehicle. I'll show the account, the balance sheet of the special purpose vehicle. So when these banks sell loan to SPVs, they keep on servicing the loan to the SPV. That is why it is, okay? And this probability of payment, probability of payment is there because there is a risk to the SPV as well. For example, what happened during the financial crisis was late to this because though in US, these mortgage borrowers, they could not pay, therefore we had a crisis. So this needs to be, there is a typo, this needs to be plus this little Greek letter, whatever you call that, I don't know, zeta or whatever you call that, that is a service charge which SPV pay to banks for maintaining and paying SPV this bit. So this has to be plus, by the way, this is typo here. And this is the gross cost per deposit, and this is the change in the capital. This is pretty standard. So we have shown this. If you set this securitization HS equals to 0 here, then you will end up in a standard sort of profit function of a typical bank, which literature has widely analyzed, which we demonstrate that in our paper. So now,
can I get in asking you, because I think this is good for the understanding of what the model is for all participants. So this is a general equilibrium model.
Yeah.
And I saw the banking sector. I saw the household sector. I saw the firms. I did not see government.
Yeah, it is coming.
It is coming still.
Yeah.
Oh, sorry.
I said that we have got 7. Worker household, entrepreneurs, commercial bank, SPV, central bank, and the government.
Okay. Is that in your model, or you have not finished your model yet?
No.
Okay,
no.
Great. So I'm looking for the government because the important role that government is playing. So so please continue.
Okay, if I may, I'm sorry, I will be disappointed if there will be no role for the government here.
Government runs no role. Okay.
Yeah,
that's why I asked this question. Why do you think a government should not be in your general equilibrium model? And think about what the governments are doing during the COVID, during the financial crisis, and also money market operations. So why do you not include the government into your model?
Let me answer your question by asking a question. From the point of view of bank, what is government? The regulators.
Central banks.
Okay, regulators. There. By government, what we do not do here is that how government raises revenue, how it spends taxes. We don't do this sort of thing. Right?
So
you
take the central bank into your model, and they are reflecting the government activities.
Yeah, well, even central bank does not tell what banks should or should not do. Central bank sets a policy rule. Yeah. Regulators are here to say what banks should and should not do. And how regulators do that? By setting up the regulatory framework. As you pointed out, Basel III. As you pointed out yourself, post 2010, what banks are told? They have to look their distribution of risk. They have to calculate risk-weighted total asset and maintain 10 or 15% of that risk-weighted loan as a capital stock. That is what the government is in the model. It's not political science. It's economic model.
But government is also a very important economic player, just like us, household firms and government.
So what would you like to run government a commercial bank?
No. I'm thinking government participation. Sorry. Okay. Now I gave up. So Yana, you have your hands up.
I think I didn't read the paper proper. I mean, is that? But I suppose Kuhl and his co-author try to simplified the model, is their government roles coming as like ratios is the BIS as a BIS ratios in the model, so that is they are sort of ignoring the other role of the governments. I think that is that's my intuitively guessing.
Look, there is a confusion between economic models and how economic models fit government, right? Go and look at any DSG model, right? So whether you are talking about lower bound, what happens when the interest rate is close to zero or all sorts of literature are there. For the banks, the role of government boils down to developing, structuring, and implementing a regulatory framework. Unless it is North Korea, probably, I don't know, even that happens in North Korea, government do not run banking institutions. They control banking institutions through regulatory framework. And I spent quite a bit of time explaining Basel III in-game proposal, right? So if these proposals are compromised, what is going to happen? That is what we do in the model.
Is during the crisis, what happened? The government took over the banks, even including the UK, and then they were running the banks. That you should remember that your model should implement these things, but it's a perfectly you can just ignore those, and a model you can say, look, the model the government entered the model, the SG model is from this channel, and I'm very happy on that. But I think if you argue that is the government should not run the commercial banks or not, but if you and we are very well aware of that. When the crisis come, is the last resort, government take over, and then run the banks.
The same. I'm a householder. I'm not running a bank, but I'm in your model. So I'm thinking about the government the same as participants in financial.
You are in my model because you save. Your household, you save. Your household, you save. You create deposit. That's why you are in the model.
Yeah, government also borrow, right? Yeah. So they borrow. Those are the But anyway, let's think about it. At least we have more angles to understand your model. And also, actually, if I may, I do not see the element of capital market apart from the banking sector. So how do you think about the other element? I mean, maybe other elements of the financial system. Are they relevant in your model, or?
Everything is relevant in the world. If you are doing modeling, you have to consider what is tractable and what is not.
Okay. Yeah, I follow you. Yeah, that's your paper. So thank you very much. So can we continue, please, Professor Luintel? Yeah, thanks.
Now, here, there are a lot of things which needs to be done. One paper cannot address everything. It is not impossible to solve the model, right? So one has to focus in a particular aspect and see how it works. And what we are doing here is, as I have already understood, the implication of securitization and how it's compromised leading up to the financial crisis. What will happen if we are not to regulate this thing properly? And that is where the government's role comes in. And then how, and those who are proponents of securitization, they say that, it is a good thing. It helped raise liquidity, credit in the economy, which has an expansionary effect. Whether that is true, we are comparing by simulating our model with and without securitization. Okay? Right, let me carry on. I think I need to push. Now, just this is the special purpose vehicle, SPV. Assets is loan from whatever loan is bought from the commercial banks, and liabilities these loans are repackaged and sold to the wider market. That is where the capital market comes in, which you are talking about, which you were talking earlier on, capital and money market, right? Now, so this is the restriction, and SPC also maximizes its profit because it is a separate entity. So it pays, this is the cost, this is the capital, VT is the capital it raises from the wider market by selling these tranches of securities. It has got a cost. The SPC has to service those investors, pay daily, monthly, weekly, whatever they have, bought. And this is the plus. I was saying that earlier on. There's a typo. This is the commission the SPB has to pay to the commercial bank, having purchased the loan for maintaining the loan service. For example, if Barclays sold my mortgage to the SPB, I'm not going to pay my mortgage to SPB. I keep on paying to Barclays. I don't know what is going on with my mortgage. So Barclays raises mortgage payment from me and pays to the SPB, and that is the fee here. And rest is, this is the money which amount liquidity which banks have raised from SPB by selling. If I were to use the 20% example earlier on at the beginning, that 200 million or whatever. Okay, so this is SPB. So that's it. Now central bank. Central bank. What central bank does in this model is central bank simply sets policy rule. Policy rate. Okay, which depends on growth rate, and this is the long run desired policy rate. For example, Bank of England has a policy inflation of keeping inflation less than 2% or below. For that, what should be the commensurate interest rate, nominal interest rate? This is this, and it adjusts this policy rate partially looking at that and that particular objective. In this case, what we have done is with the typical to the this DSG modeling, this policy rate reacts to the growth rate. Okay, this is what central bank does. Now, what is this? Okay, this is what central bank does. Now, going to the government. Now, here in this model, government runs balanced budget. It raises taxes from consumption, from wage income, and from rental capital, and from deposits, and distributes lump sum to the household, workers, and entrepreneurs. That's all government does. Nothing to do with this fiscal instance of government, visa, and its different role, which is to set up the proper regulatory framework, which is what is essential for the banking industry. Okay, so putting together the overall balance sheet of the country or financial system is total loan, comprises of unbalanced sheet and off-balance sheet loan, and this is deposits, this is bank capital, this is securities, which are sold via SPVs. That's what it is. That completes the model. Okay, so now there are lots of parameters. We calibrated the model. I'll say quickly. Yeah.
Can I
Please.
Sort of not ask a question, but is the on the securitized loans, the loans supposed to be offload and then not return back to the balance sheet of the banks that they originate.
Sorry.
Only the
this one?
Yes. I mean, that's what is the only the part that is the might go back to the originator.
Sorry, can you repeat? I can't understand. Can you repeat, please?
So in the securitized loans, in the SPV type of the securitization loans, the importance of the key is the loans that been securitized offload to market.
Mhm.
And then will be the origin. It might not come back to the balance sheet of the originated institution.
No, it will not.
Yes, it is only things that is the link where they can be happen. Equity part that is the originator to hold. That part it will be the remains on the risk of the
So that is what
originator.
exactly if I may interrupt, I think I understand what you are saying, trying to say. That is what exactly we do. This hasty is not a bank balance sheet. This is the economy's balance sheet. If you look at the economy has got loan from the bank, with the loan which is off balance sheet of the bank, and it also has got deposits, this bank capital and the securities. This has to be matched by the left hand side has to be matched by the right hand side. That's all.
That's good.
The
other things.
Therefore, the aggregate balance sheet of the financial sector. This is not bank balance sheet.
Okay. This is the other part that is you have to look at revisit the model, especially the SPV profit maximization the equation. SPV is a charge. They are something special institution. Only the service charge, and then until the last loan repaid, they will be disappeared in there. So I am not sure where is the profit maximization. They can have the fee, which is the if you say that is a profit equal to fee.
SPV are on their own completely legal individuals like banks. You cannot say that SPVs are a separate department of banks. No.
But what is the profit maximization?
They have maximization. If you have to exist in the finance in the world, you have to maximize. You are an institution. You have your staff. You need to do auditing. Everything the bank needs to do, they need to do. They are legally established entities. They have to abide by everything. So they have got cost, they have got income, and if they are any institution which need to survive, they have to maximize profit. Otherwise,
possibly I'm not going to take your time, but have a look and then or ask the court to revisit this point.
Okay, thanks.
Yeah. Okay. So, please continue. Thanks both, and thanks for your patience, Yana. I'm waiting for me to, but you jumped in fine. Yeah. So, where we were.
So right. So now, in the interest of the time, so what I'm going to do is quickly take you through. I'll show you all these parameters we have to calibrate the model. We did not estimate the model. This is a calibrated model. So this is discount factor of worker entrepreneurs, weight of consumption, etc., etc. We have taken these sort of parameters to now simulate the model from the literature established, widely established from the literature. Okay, so I'm going back to the same place here. Right. Okay. Now what we do here? This is the first thing we do. We simulate first. Given the interest in the paper and the sort of question I'm facing, let me explain slowly in 2 stages. First, the purpose of this simulation is to work out how does a statutory capital adequacy ratio gets compromised when the percentage of securitization increases. Is that clear? In our model. So what we have got here is this we write effective BIS rate, capital adequacy rate. We start from, let us say, the legally required rate of 10 is 10%. When securitization is 0, legally required rate is maintained 10%. Now, in the x-axis now, ratio of off to on balance sheet loans. So let me explain. 0 means there is no securitization. 1 means there is 50% securitization on balance, 50% off balance loan. Is that clear? This is important to understand this graph. So for example, 0.2 means you can do a little bit of algebra and solve for this. 10% securitized, 90% on balance. 0.8 means 40% securitized, 60% on balance. 40 off balance, 60 on balance. 50 on balance, 50 off balance. This is what it is. And when we do the simulation in our model using those parameters and all this optimizing behavior of our model, this is the graph we get. So what happens? What we looked at, this may not be visibly clear here, but we have looked at in the results, the number in our simulation. So now, if you go back and try to remember the first graph, the sudden drop in the securitization ratio to 18%, before that, it was 44 to 45% securitization in the United States. That is somewhere near sort of, so near here. So this is not 40% securitization, because that is the total ratio I calculated. This is the ratios of on balance and off balance. Therefore, you cannot directly calculate. Therefore, we went and looked at and we have done the calculation. So when securitization rate was 44% in the USA, leading up to the financial crisis, according to our results, the 10% BIS ratio legally required BIS ratio would have been 5.3%, somewhere here, 5.3%. Okay, 5.3%. So therefore, this graph shows that because of the unhindered securitization, I'm not saying that securitization at this stage post the global financial crisis is unhindered, but up until then, it was completely relaxed. So relaxed securitization led serious compromise in the capital provision of banks. And the capital, according to our model, given those parameters in our model, whatever we do, what it tells is that, securitization prior to global financial crisis, the BIS rate was 8%, de jure, but according to our model, de facto capital adequacy ratio as maintained by the banks was 3.8%. And by the way, our 3.8% more or less is very close to what Admonti and Hilwig write in their textbook of between anywhere to 2 to 4%, 2 to 3% big banks were maintaining. That is what we find here. This is the first result. So first punchline is that leading to the global financial crisis because of securitization, the effective capital adequacy ratio maintained by bank was 3.8% against the required 8% legal capital adequacy rates. This is what it is. Now, this is the wrong table. Now I have to go to the paper now. So I'll show you this. Now, so how does, in this table gives the steady state simulation of how does securitization and non-securitization scenario when now capital adequacy ratio is increased from 10 to 15% affects the aggregate economy. So one of the first thing is that, let us start with this. First thing is that when securitization is on, when securitization, there is no securitization, BIS rate of 10% means BIS rate of 10%. BIS rate of 15% means BIS rate of 15%. De jure and de facto coincide, that is what you expect. Now, when there is securitization 10%, the effective rate will be 7.4%. Okay? But when it is increased from 10% to 15%, this is what the Basel III in-game proposal says. Depending on the risk structure, this ratio has to be 10 to 15%, right? If 15%, if without bringing securitization, the way these big banks are lobbying, even if tomorrow 15% capital adequacy ratio is set as a de jure, then de facto will be only 6%. Okay, this is a counterfactual scenario. Don't ask me, that is not possible. Yes, I understand that's not possible. This is one scenario, if you like, baseline scenario. So now, okay, if that is the case, secondly, securitization ratio increases off balance sheet from 20% to 57%, 58%. Okay? Now, those who support proponents of securitization, who are lobbying against the Basel III sort of proposals, one of their argument is that securitization is good because it expands credit and it exerts expansionary effect in the economy. Now, if you look at these two, there is not much change from 10% to 50% within securitization. But if you compare no securitization, there is some expansionary effect. But probably you may have noted that this a bit of slightly above marginal expansionary effect is at the cost of huge off-balance sheet activities, which compromises the systemic risk of the financial system. Okay, so this is what we do, and there are a lot of information here. In the interest of time, I'm going to now quickly revert back to the slides. This is it. So now what we are going to do is we are going to do some policy simulations here. First is typical TFP shock. Okay, first is TFP shock means if the productivity in the economy is increased by one standard deviation, positive shock, how will this economy will behave with and without securitization? So these red dotted lines are without securitization, and these blue lines are with securitization. Okay. Now, first thing is, let us look at here. Without securitization, off balance sheet will be 0. Therefore, there is a line on top of this red dotted, which may not be able to see this. Let me make it bigger. This line. Okay. So because of securitization, off balance sheet loan increase, on balance sheet loan decline. Okay. And bank capital also compared to non-securitization, securitization scenario suffers. So loan interest rate initially rise. These are impulse responses. And then what happens to output? There is not much difference between with and without securitization to the output response, but output is positive because you expect this is what we call, productivity shock, which increases productivity and output. Capital stock accumulates, deposit and loan accumulates. Now, what this is showing is that during boom, during positive shock, securitization does not cause that much expansionary effect, which is what is being argued by the proponents of securitization, or those who are arguing for the relaxation of these Basel III sort of rules, proposals. But it does affect and increase the balance sheet activities, and that will have implication on the systemic risk level of the financial system. So there is not much expansionary effect. This is what the TFP shows. Now, going back to Now, we also looked at, okay, what happens if you increase required capital adequacy ratio by 1 percentage point? Okay, in this model, what happens? Obviously, deposits decline, loans decline. When capital requirement is increased, there is a sharp fall, what we call overshooting, sharp fall. When there is no securitization without SPV, because of the off-balance sheet activities, somehow reduces these sharp sort of decline in output, this overshooting effect. Overall, output declines, capital stock declines. So if you look at the next page, so bank capital has increased without securitization by the magnitude of the shock. That is what we expect. But because of the off-balance sheet activities going up, because the required capital has increased, capital requirement has increased, off-balance sheet loan has gone up, on-balance sheet loan has declined. Therefore, the bank capital has not necessarily increased. This is below zero when there is securitization. So what does this simulation shows is that, as expected, when you increase the bank capital requirement, commercial banks lending suffers, okay, that will have implication in capital formation and output. That's fine. But at the same time, banks are able to thwart, if you like, to frustrate the regulators' macroprudential policy, which it is likely to implement. It is trying to implement through increased capital adequacy ratio. This is second simulation. Third simulation, what happens if we were to relax the lending environment, borrowing environment for both banks, particularly borrowing environment for entrepreneurs and lending environment by increasing the loan to value ratio. Okay, loans increase when you relax the loan to value ratio. Okay, and then output goes up. Look, this is impulse shock. Capital stock shows very different dynamics between with and without securitization. In order to understand that, you have to look at the off-balance sheet. Look, when you relax loan-to-value ratio, securitization decreases. Off-balance sheet loan declines. These are negative numbers. On-balance sheet loan increases. So effectively, what does this show is that banks are using securitization just to evade stringent control, like high loan to value ratio, high required capital adequacy requirement, etc. Okay, so bank capital builds up, and there is an interest rate effect. Interest rate also goes up. Okay, so this is what loan to value ratio shows. Mostly relaxation of loan to value ratio reduces off-balance sheet activities of banks. Now another simulation we have got is now credit risk. When credit risk goes up, one standard deviation increase in credit risk shock. We have simulated. You expect everything negative because the credit risk is bad. Therefore, output goes down, capital stock goes down, deposits falls, loan falls because there is credit risk. Okay, so off-balance sheet activity increases, on-balance sheet declines, bank capital declines, everything is negative. What securitization does is securitization, if you look at, amplifies the negative shock of credit, increasing credit risk. So these are the sort of simulations we have done in this paper. So I'm sure there will be some discussion probably, but before that, let me summarize what this paper is, what we have done so far and what we have found. One, securitization, we have demonstrated that greatly compromised the capital adequacy ratio leading up to the global financial crisis. According to our model, the then capital adequacy ratio was 8%, but the effective capital ratio which banks were maintaining when you take into account their on-balance sheet loan was 3.8%, less than 50%. We have also demonstrated that unless we are not saying that this securitization has to be completely wiped out, we are saying that they are a good vehicle in order to generate liquidity from illiquid loan which sit in the bank balance sheet, but they has to be supervised and brought into the fold of supervision and capital adequacy requirement. Therefore, unless they are brought into that, then this will compromise any macroprudential policy, including the whatever is being proposed under Basel III. For example, our simulation showed that if you leave the way securitization used to be in the past, I'm not suggesting that is going to happen, but this is just a counterfactual simulation, then 15% de facto capital adequacy would simply maintain, bank will maintain less than 7% of the, 15% D0 to less than 7% de facto capital adequacy ratio. Now, the expansionary claim that if you limit securitization activities of banks, that will limit access to liquidity, that will limit risk transfer, etc., and that will limit growth opportunities, which is being put forward. At least in our model, we do not see there is a marginal expansionary effect of this securitization, but there is not a lot expansionary effect which we find in the analysis. And moreover, securitization amplifies upturns. That is, when the economy is booming, it even amplifies the boom environment, and it exacerbates the downturn. So effectively, if you would have probably preferred, we would prefer when economy is in downturn in the business cycle, securitization should help expand the economy, ease the downturn, but that is not the case. It exacerbates the downturn. That is what our model shows. And finally, whatever marginal expansionary effect we have found in our simulation, that comes at the cost of significantly expanded off-balance sheet activities of banks, which has got direct relationship with the systemic risk. Higher the magnitude of off-balance sheet activities, higher will be the systemic risk of financial system. In the first place, that is what brought the 2007-2008 financial crisis. Thank you very much.
Okay, thank you very much, Professor Luintel. And I think you covered actually a lot of things that are related to this, the impact of this securitization from the commercial banks, particularly on regulation, from regulation aspect. So so I think we probably have some questions from the audience, and let's see whether we can pick up some questions. And you, I'm sorry, the time is a little bit over, but I hope you can stay for a few more minutes if we have some questions.
Yes.
Do we have any questions? No hands. So I have been thinking about the policy implications of your research.
Yeah.
In fact, you focused on how this securitization particularly will change banks, the so-called the capital ratio requirement. How does this affect whether or not they meet the requirement? But I'm also thinking about the banks. So obviously, you have one simulation in a result that is about the riskiness of banking sector with and without securitization. That's obvious. So the more securitization, the higher risk. But what about banks' performance? Let's say banks' profit. I'm thinking they still do that after the global financial crisis. Even the regulation is changed in response to that, but they can still do that. And Yana mentioned there is a coming back. Actually, I mean, shadow banking activities are everywhere, and I heard that they do this because they were restrained or constrained by the regulation. But the off-balance activities, they can, as you mentioned, evade the regulation. So if I was a bank, I see my peers are doing this. I need to do this as well. So banks probably can benefit from doing so, and their base of assets or liquidity assets or total assets may be higher than before. That provides probably a larger base for them to do more securitization. So I'm thinking about that, but I do not have the answer. So I guess the banks are doing well because of this securitization process. How do you think about this? So they benefit from them. If banks are benefit from them, then nowadays they are working with the non-banks financial institutions. So that means that they can transfer a lot of liquidity into the system and think about the small and medium-sized enterprises financing. So they may have contributed quite a lot to the system, to the society.
Okay. There is no question that liquidity is good. Okay, but how you go about doing it is important. What we have seen is that because of the SPVs, first big casualty was Enron in 2001 or whatever, if I remember correctly, because they used SPVs to hide all their bad debt, etc. Now, because of this excess liquidity provision, until probably just get for a second, just coming out of this mindset of economic models, if we try to remember mortgage market, simple example, even in this country, up to 2007, mortgage lending was available everywhere, very cheap rate. They didn't care much about whether there is affordability or not. So this is because this excess liquidity from the rest of the financial sector, if you like, you can call money market or capital market, was flowing into these institutions because they could securitize this easily. Until suddenly, this issue of, at the end of the day, anybody who borrows whatever needs to be able to pay. And when these Americans started failing to honor their mortgage, then everything collapsed. As I said at the very beginning, BNP Paribas, for the first time in August 2007, said, okay, because the upheavals in the mortgage market in the United States, we cannot value these instruments. However, these were A-rated, B-rated, C-rated, whatever, and everything. And immediately, these investors are very quick to respond. All the, private market of the securitized asset collapse. Therefore, going back to your point, nobody is doubting about the positive effect and potential of liquidity being injected into the economy, but that has to be done properly. When I say properly, with a measure of risk. Therefore, this whole concept of this regulation, the concept of government, which you brought into earlier in the discussion, is, as far as I am concerned, as I understand, is towards shaping an environment whereby neither banks are unnecessarily penalized, nor the rest of the economy is exposed to unnecessary risk. That is what is. So there are always vested groups on either side. Somebody might be arguing, saying that, okay, banks should not be earning so much profit, etc. Why securitization? We need to have a 70s and 80s type of, early 80s type of bank without securitization. Somebody might argue, but that is not what will sell. As you rightly pointed out, that will simply narrow down the liquidity base of the economy on the one hand, and that is simply not the sort of policy which will fly anywhere in the contemporary world, because the world economy is very competitive. There are geopolitical factors, there are other things. Therefore, the idea is that, yes, you are right in saying that if we were to allow securitization, no doubt it will increase liquidity, it will increase however marginal or whatever we call expansionary effect, etc. And therefore, there is no doubt. But the question here is, as I said earlier on, it needs to be done in such a way that we do not take excessive risk on the one hand, and in terms of mitigating excessive risk, we also should not sort of marginalize banks or prevents banks doing whatever innovative work they can do.
Yeah, but, I do agree. So we have do we have some other comments? I heard from but then Professor Luintel. So I'm thinking more about, I'm concerned more about cryptocurrencies, those digital currencies, and those the more advanced technology things. They are much more riskier, right, as compared to those securitization assets. At least they are related to the banks, even though they are off balance sheet, but they help their balance sheet activities probably. So what do you think about those technology things? Crypto, pardon?
Two things I would like to. First, I don't know much about digital currency, and therefore I cannot answer your question. One. Two, secondly, as a layman looking at the press, etc., yes, these digital currencies are coming very strongly. Several central banks, including Bank of England, is contemplating to launch its own digital currency, and how that will impact on banking sector, and how government, particularly central bank and governments, will regulate these sort of things is something very interesting to look up and probably something to research upon, which I don't know much about. Therefore, I do not want to say anything on this aspect. I'm sorry.
No, thank you very much. But still, the direction is to regulate. I do agree. So do we have any other comments or questions?
I'm afraid I must say that I need to put a hold on that. Now I've got another meeting to go.
Yeah,
so
okay.
Okay.
So in that case, thank you very much, Professor Luintel, for your patience and your answers to our interactive questions. So we do not have that many questions. Maybe that's related to the topic, but thanks for people who raised the issues, and thanks, Yana, for your questions, and thanks everybody for your time.
Thank you for the call.
Pleasure to have.
Okay, thank you very much.
Thank
so
you very
I
much.
now can close this session. As we said, let's have some other opportunities to continue the discussion about that.
Absolutely.
Very interesting topic. Thank you.
Okay, thank you very much.
So
Thank
you have,
very much.
yeah.
Bye.
Okay,
Bye.
bye-bye, everybody.
Bye.